So you've done it. You've built something real, investors are starting to notice, and that first check, you can almost feel it in your hands. It is an absolutely incredible moment. But what if the signature that unlocks all that growth could also lock you out of your own company? Let's dive in and talk about how you protect what you've built and make sure your vision stays yours.
This quote from our source material really hits hard, mainly because it is terrifyingly true. These documents, often just handed to you as standard or non-negotiable, can have these massive consequences that you just won't see coming until it's way, way too late.
And that, right there, is the big question we're going to tackle in this explainer. Look, this isn't about avoiding fundraising. It's about understanding the game so you can build your company on your terms, with the right partners who are actually aligned with your mission.
I'm sure you've heard it. Oh, it's just a safe. Or don't worry, this is all just boilerplate stuff. This is one of the biggest and frankly most dangerous misconceptions out there. These aren't just formalities, okay? They are legally binding contracts that are going to shape the entire future of your company. And here's the bottom line. A confusing clause that you accept today, maybe out of excitement or fear or just inexperience, well, it doesn't just go away. It waits. It can completely complicate your next round, torpedo your ownership when you least expect it, and ultimately, it could cost you control of the very thing you've poured your life into.
All right, so let's get into the nitty-gritty. We are going to break down some of the most common and most dangerous clauses you're likely to see. Think of this as your field guide for spotting the landmines before you step on them.
The safe note. It was created to be simple and fast. And you know what? It often is. It lets you take on investment without having to fight over a company valuation right away, which, let's be honest, can be super tough when you're just starting. But, and this is a big but, simple does not always mean safe.
This slide just lays it out perfectly. You've got the promise versus the peril. The promise of speed is so appealing when you're running low on cash, but the peril of an uncapped safe? It's huge. An uncapped note is basically like giving an investor a blank check for your equity. The more value you create, the more of your company they get. It's a disaster waiting to happen.
Let's make this real with some numbers. Say you raise on a safe with a $2 million valuation cap. Then you go out and you just crush it, raising your next round at a $6 million valuation. Well, that first investor's money converts at the lower $2 million cap, meaning for every dollar they put in, they get 3 times the equity of your new investors. This is why a cap is so important. It sets clear expectations and protects you from getting wiped out by your own success.
And then there's the discount. It's often pitched as, a fair reward for an investor taking a chance on you early. But think about it from another angle. If you do an amazing job and drive your valuation way up, this clause forces you to sell your shares to that early investor at a discount. It ends up feeling less like a reward and more like a penalty for being successful. Okay, lightning round. Let's hit a few other clauses you got to watch for. First, MFN rights. This can create a domino effect where one sweet deal for a new investor automatically upgrades all your old ones. Not good. Next, pro rata rights. These can fill up your future funding rounds, leaving no room for that killer strategic investor you need later. And finally, giving away board rights or veto power way too early, you could let a tiny investor grind your entire company to a halt. Each of these is a huge red flag.
Okay, enough with the doom and gloom. We've identified the traps. Now let's talk about how to actually navigate this maze. This is the founder's playbook. We're going to build a strategy for negotiating clean terms without scaring off the right investors.
Here are 3 things you can do right now. 1, always, and I mean always, model the math. Run the numbers in a spreadsheet and see exactly what your cap table looks like after these notes convert. 2, watch out for stacking. One safe might seem simple, but 5 of them with different terms can create an absolute nightmare for your next round. And 3, ask the tough question. What happens in a down round? You have to know how these things work when things go wrong, not just when they go right.
We know what they say. The best defense is a good offense. Go into these conversations with your own simple, clean terms and keep the documents boring. Boring is good. Trust me. It means predictable and clean, which later stage investors absolutely love to see. And I'm going to say it one more time. Never, ever, ever use an uncapped safe. It's just not worth the risk.
So what if an investor pushes back on this stuff? Try this line. It completely reframes the conversation. You're not being difficult. You're being a responsible leader. You're being a good steward of the company. It shows you're thinking about the long-term health of the business, which is exactly what a good partner wants to see.
But here's the real secret.
The best negotiation happens before you even sit down at the table. The ultimate power move is to build a company that doesn't desperately need the money in the first place.
So how do you do that? First, build a moat. Turn your cool tech into defensible IP. Second, focus on hitting technical milestones. A working prototype is infinitely more powerful than a fancy pitch deck. And third, build relationships, not rounds. Ask potential investors for advice and feedback long before you ever ask them for a check. That trust you build, that's the ultimate leverage.
All right, let's bring it all home. Raising capital is a tool, okay? It's not the goal. The goal is to build your vision and have the freedom to actually steer it. And protecting your ownership is fundamental to making that happen. Remember this, turning down that first investment offer can feel terrifying, but taking a bad deal can be catastrophic. It can limit your future choices, it can put you in a corner. Sometimes the bravest and smartest move you can make is to walk away and just keep building.
And this right here is the core takeaway. The whole startup world glorifies speed, speed, speed. But thoughtful, intentional fundraising, that's what builds companies that last. It's about finding the right partners on the right terms that set you up for success in the long run.
So I'll leave you with this question. As founders, you obsess over writing clean, elegant, well-architected code. But is your ownership structure, your cap table, just as clean? Because in the end, that's the code that determines who really owns what you build.